Meow, everybody, I'm Cantonese Cat. Hey everyone, Cantonese Cat here. Wonderful Saturday so far. I want to share my thoughts on a little bit about psychoanalysis, what cycles mean, why they happen, what you would expect by looking at things, what you should look for, and what you can potentially do something about it, and also why they happen, at least based on this cat's version of it anyway. None of this is absolute truth. I'm just basically telling you what I think, right? The way I think is this. Whenever you're sitting around, you have a new idea pops up in your head. And this idea could be because of something that you already knew from before, based on your experiences, something idea that you came up with that nobody else had come up with, but it ends up saving you money, it ends up saving your family money, it ends up saving your company money, it ends up saving your community money and effort. It ends up saving time, it ends up making things moving a little bit more efficient. You're creating a deflationary force. The economy capitalizes on deflationary forces. Anytime when you're able to make something more efficient, you're creating wealth. You're basically making the quality of life for everybody better. And there could be some small degrees of it, there could be some larger degrees of it. And some of these are systematic, some of these are individual. But eventually, the humankind has gone through a lot of tremendous challenges that have created a lot of different innovation. And from those innovations, you end up creating a lot of deflationary forces. Things just cost a lot less to do, and also they take a lot less time to do. And with that, when that happens, you're really able to create more money. And the Fed capitalizes, the government capitalizes on this possibility. And they just keep printing money, they keep spending money. They're trying to prevent deflation from happening too much because they actually want a certain level of inflation to happen, which could be healthy, at least, both psychologically, as well as for the growth and the spread of wealth around the world. It is important to be able to print money to increase the wealth of economy in nominal numbers. There are a lot of people that says that, yeah, if you just look at S&P 500, it's been growing. Look at Bitcoin, look at IWM, it's been growing, but it's just been growing at the same degree of when the Fed prints money, which is ridiculous. Like, this is not a real growth economy. The Fed just prints money, and that's why stocks goes up along with it. I think that's a very, very faulty thinking. The fact that the Fed prints money is because they're able to. If you're not able to print money, there's not enough deflationary forces. You're going to end up hitting a bunch of inflation, and you're going to end up having to slow down a printer or even do monetary tightening, which we've been doing over the last couple years until recently when global liquidity goes up again. The key is this: why do we have cycles? The overall theme is that we want to print as much money as possible. We want to grow wealth as a society, as a country, and also as the world. We want to print as much money as we can. There are also some other motives that go along with it. Obviously, if you print as much money as you can, you have more political power. You can prevent people from revolting because you're basically keeping their 401k retirement funds happy by showing them, hey, there's some growth that's happening with your retirement funds here. You're also able to win elections with it. So this is all very, very beneficial for a lot of the politicians, for countries, for people that are running things behind the scene. And this is also very beneficial for people who have money. They're trying to look for ways for their money to grow as much as possible. And they're going to look for anything that could give you some outsized return. They're going to try to time the market as much as possible. This is all very, very big motivation as to why money is growing. It's not just because the Fed prints money. It's not just because it's ridiculous. It's economy, is business. This is how things have been working, and there's a reason for it. Now, when things happen out too far, too fast, if they print a little bit too much money, what's going to happen is you're going to end up having a lot more inflation. And when that happens, the Fed needs to slow down the money printing. The government needs to slow down the money printing. And things might get a little bit too far out of hand. The deflationary force is not catching up to the money printing. And that's when you end up having some sort of pullback, some sort of recession, when you're just going to have people who end up not having enough jobs to go around, not having enough money to go around, and people are going to end up suffering in the short term until these tough times bring on innovation, until deflationary forces come back, and then people are starting to have enough improved quality of life that allows us to really start printing money again. And this also doesn't necessarily have to do with just us. This is also happening globally, right? For example, in the 1980s, the very big reason why we're able to kind of get out of funk, if you look at the SPY here, actually let's look at SPX. This is a 3-month chart of the SPX. If you look at the whole idea about what happened back in the 70s, there's a tremendous amount of inflation that's been created. They've been spending like crazy. Innovation was happening very, very slowly. There wasn't enough resource to go around, and particularly, like things like oil and things like that. There's just a lack of, enough resources to go around. There's too much inflationary forces, too much money squished in the system, perhaps because of the conflict we had in Vietnam. There's a lot of money that's being printed than necessary, and progress just didn't catch up to it, right? So you end up having a lost decade here until something happened in the 80s. We're able to have a lot of innovation being caught up, maybe because of computers, maybe because China was able to flood our economy with a bunch of cheap products to help with the deflationary forces. Regardless of why that is, we are starting able to print a lot more money without causing a whole lot of inflation in the 80s and in the 90s. And that's just gone a little bit too far out of hand. The computer narrative was great, but at a certain point, the deflationary forces just wasn't fast enough to catch up to the amount of money that's being printed. And that's why we end up having another recession and having a lot of lost decade over here. Now, since then, this is the SPX. These are 3-month candles. Right now, we might be having a pretty big deflationary force right here. It's arguable in terms of whether or not it's a bubble or not, because it's arguable in terms of whether or not this is actually creating enough deflationary forces to allow us to push the price up even higher for the indexes and for assets. The biggest thing is this. Whether or not there is enough whether or not there's enough deflationary forces is questionable. Is AI causing changes to our everyday life? I believe so, right? I mean, right now you're really talking about people having a lot of AI generated work, a lot of the writing that needed to be done initially by people are no longer needing to be done by them anymore. A lot of the email responses and articles can actually be done pretty well with AI. So it actually is saving a lot of money, it's saving a lot of costs, and this really just happened over the last, year or two. Like, this is something that's completely new. It also has improved the resources in terms of information that's being spread. It improves our ability to find information because we're able to ask the right questions rather than, sometimes even Google, no matter how good Google has been over the last 10, 15, 20 years, sometimes you ask something and it's still not really able to give you a comprehensive view. But right now you have enough AI models that are able to find the right resources for you. Even if you ask a question, is able to use some language learning model to try and figure out what it is to let you know exactly what you want to do, or at least get you closer to a ballpark. Is able to come up with a whole concise article, if you will, that are specific to your questions rather than just a generic article that's on the World Wide Web for you to search and you're hoping that there's that particular article that addresses your question. AI is really able to save a lot of costs and save a lot of money. In addition to that, there's also tremendous amount of work that has been generated to try to make that happen. There's also tremendous amount of resources that's being pulled into it to try to make it happen. A lot of investments has been put into place, and we're also having a more and more powerful infrastructure to develop something like this, including NVIDIA. They're building all these very, very, very powerful chips that's going to make this process a lot more efficient moving forward. So there is actually a lot of deflationary forces that's happened. In addition to that, I'll also argue that we've gone through something that's very, very, very rough in 2020, which is COVID. COVID, and I'll show you in a little bit too, COVID is actually a true black swan event. It's not just like usually if you think about recession, as far as I'm concerned, overwhelming majority of recessions are not because of black swan events. Overwhelming majority of recession is because of cycles, is because it's probably just time for it to happen because things have gone a little bit too far, too fast, and too euphoric, and there's just too much money in the system, and not enough of resources, and not enough of deflationary forces to allow that to catch up, and that's when a recession happens. That's more with cycle, but with COVID it's a little bit different. COVID actually is kind of unexpected. It actually for a little bit, for us a little bit off cycle. I'll show you a little bit with the IWM chart here. The key thing though is that even with COVID, it did create a lot of deflationary forces. Remote work has actually been a thing now. Initially, when you had remote work, there's a lot of resistance. There's a lot of company cultures that are against it, but it's becoming more and more receptive. You can say that some of it has been kind of bounced back the other way. There are some companies that are trying to get people to get back to work. There are people who are trying to get a hybrid model, but in reality, is this there are actually a lot more virtual care, virtual work in general. In the past, if you're just talking about like 5 years ago, healthcare, if you're talking about people having virtual visits, it's kind of unheard of. I think doctors worry about billing. They really want to bring you in and they really want to talk to you face to face to make sure that they get the right amount of billing that they need to make the amount of money that they want, right? In addition to that, they've also been trained to do these physical exams that they have to see you physically for. And they're always worried about risk and things like that, right? So initially there's a lot of resistance and also just a lot of inertia. People just don't want to change. Initially there's a lot of resistance in terms of that. Now you're actually talking about like virtual visits in the clinic. You're talking about virtual work where initially there's a lot of pushback against working remotely because you're not going to be able to be as engaged. We want FaceTime. We want you to show your commitment. We want to build a community and things like that. But right now we're starting to realize that yes, culture is very important. But on the other hand, it's also important to get the best people to work for your company, to get people to be most productive as much as possible rather than ask them to get stuck in traffic for like 2 hours a day. You want to increase productivity. So there's actually a lot of deflationary forces that has happened over the last few years, if I would argue that, to make us be able to start really printing money again, to bring down the inflationary forces, and to really just get the economy going again. I think a lot of people don't really understand that, and they kind of just get stuck in the mentality like whatever happened over the last few years has to keep on happening. It doesn't always have to be the case. Now, this is the IWM 3-month chart. I'm going to pull a little bit closer here to show you the 1-month chart here. You can tell that the IWM is very, very cyclical. Ever since the great financial crisis and we pumped out of it, we've really been having these 3-year cycles that have been pretty well predictable. And as we pump our way out of the great financial crisis on 2009, all the way up to around 2011, 2012 or so. This is considered to be one cycle, right? It went up high, corrected sideways. That was one cycle. Now, around 2012 to around 2015 or 2016 or so, for about a 3-year period, we have another cycle right here where there's a big pump up, and there's about a year correction right here. And as you can see, that's another cycle. And then from around 2016 or so, pumping all the way up to around 2019, you have another 3-year cycle where prices kind of went up for about 2 years. And eventually, we ended up having a pretty bad sideways over here. Now, I would argue that if you look at a lot of the technical indicators, for example, I'm just going to put some of the technical indicators right here. Look at the Bollinger Bands for the monthly. I would argue that the uptrend here and the sideways here that has already been reset, and you have an increased uptrend here that has just started right here for the other 3-year cycle that's about to come up next. Right here, the same thing. You have a little bit of a reset right here, and right here you have a increased uptrend here for the 20-month moving average. That's also another reset for another cycle that's about to pull up. And I would also argue that around 2018, around 2019 or so, you're having a very, very similar correction that's happening over here, is happening over here. If COVID didn't happen, in all truth and honesty, if COVID didn't happen, I think this would have been the uptrend maybe around like November 2019 or so. This would have been the uptrend that would have happened to kind of keep bringing the cycle up. But the problem is COVID happened. And this is really the true black swan event that we've seen over the last, like 15, 20 years. It really threw the economic cycle off. And if the economists or if the government or if the Fed didn't do anything about this and just kind of let it happen, there is actually a risk that it could break the whole cycle, and it could end up causing a lot of problems, in both in terms of technical as well as in terms of the fundamental of the economy. They did what they had to do. They overcompensated. They printed a bunch of money, and that pushed us to the moon. It actually allowed us to remain the same trajectory with a big dip right here. But it allowed us to make the same trajectory from around 2019 all the way up to like 2021. We did have about close to like a 2 year uptrend here, and then this was followed by a pretty excruciating correction for closer to about 2 years now. So I would almost argue that this economic cycle here stayed intact because they came in and did what they had to do. I would expect them to do that because that's basically what happened in the Great Financial Crisis, is that they already have changed their mindset. Now that's the point where money printing to save the economy is now morally okay. You want to make sure that banks have enough money. You want to make sure that the economy stays afloat, and that they really have switched the mindset, closer to about 15 years ago when the Great Financial Crisis happened. So this is actually completely expected, and it pumped the cycle back to where it's supposed to be, and we ended up having the same correction that we're expected to get. Although the problem with this is that before you're gonna have less brutal corrections because these are cycles, and these are having some expected forces where deflationary forces are just not able to keep up with the money printing, and then you're having a little bit of a sideways here. Deflationary forces is not able to keep up with the money printing. You're gonna have a little bit sideways over here, but the problem over here is that there's great issue in terms of deflation. Sorry, my cat just wouldn't stop meowing. I had to pause it a little bit. But during COVID, there was a great um, economic disruption, if you will. It's actually a combination of deflation and inflation at the same time. Economic activity has stopped. Nothing was happening. A lot of things that are happening in terms of services nobody really needed, nobody really wanted, because everybody's just trying to stay away from one another. Whereas a lot of things, when it comes to like goods in general, there might be a shortage because a lot of people are having a hard time going back to work and to produce things. But people are also less likely to go out and do a lot of things or use a lot of things. So economic activity has stopped. Overall, there's a great deflationary force. So it was actually a correct move to print money, to provide monetary support, to push us out of this funk. Now, they did push us out of this funk a little bit too far, and that's okay. I think if anything, I wonder whether or not the Federal Reserve or the government has thought about this. They look at the economic cycle. There's a lot of great inflationary forces that are already happening, around here when the IWM really starts to peak. I think a lot of smart money already knew that, hey, you have inflation going on. The economic cycle is probably ending. There's not enough deflationary forces to support all this money that's gushing around. We are going to have end up having a pretty bad recession. So that already has been taken into account, and you can probably see that on the bank fund too. They put in a lot of money over here, but here they really are starting to kind of distribute the stock to other people. Like there's still a little bit of inflow, but inflow is really significantly slowed down here, and then followed by that was like huge outflow, and I think that people knew that it was going to happen. This is how cycles generally happen. You're trying to fight, deflation by printing money, and you're trying to fight inflation by sucking money out. These things always go into cycle, and it's always good to kind of look at trends. You can look at the fundamentals. You can talk to economists. You can watch the news. You can try to figure out what's happening. The only problem is that people are usually very delayed whenever they are hyped up during these 2 year hype cycle. They on the third year when things are correcting, they still have a hype mindset. They don't switch. They don't change fast enough. And they end up going down with it. And when they've gone down here, they're too negative because they have already been hurt so much that they end up taking them about like a year or two to really change their mindset. And when they end up changing their mindset, the whole cycle repeats, right? Again, the only exception is really COVID. I really think that's a true black swan event, but we're able to print our way out of it. which is actually quite extraordinary. During COVID, there was a lot of deflationary forces that I have mentioned that already happened as well. And that's, I think, why we're able to continue this economic cycle. And that's why we're able to have enough deflationary forces to combat inflation. That's why we're able to start having another bull cycle that has just started over here, like it did time and time again. Like it did time and time again. And I think these deflationary forces and these economic cycles to go up can go on for quite some time. I don't know whether or not it's always going to be, every 3 years. That I do not know. I don't think anybody can really tell you that. But because of that, I do think that the economic cycles matter. And I think the best way to do it, rather than just counting time, is to look for these long-term moving averages. Look at the 20-month moving average and see whether or not hey, it's flattened. Looks like it's starting to point up. The only exception, again, is here is flattened. Looks like it's starting to point up. But then we had COVID. And I think that really was like the big black swan event that threw this economic cycle out. But before that, I think you can really truly look at that. Even as we were getting out from the great financial crisis, if you would have been smart about it, even if we bought the peak right here, if you've been smart about it, you see that, hey, there's like a 20-month moving average just starting to point up right here. I think it's time to buy. I might miss all this great big move right here because I didn't want to buy a falling knife or catch a falling knife. But if you would have seen this, you would have bought right here, even if you were going through a pretty painful, 2-year span, you would have still been fine. Very same thing here. You would have bought right here, even though everything you bought right here eventually would crash down here, which is pretty brutal. But I still think that you would have been fine. Like, if you would have bought right here over the next, 10 years or so, you would still probably made a lot of money. So I guess what I'm trying to say is be smart about it. Look at the cycle. Think about the economy for yourself so you're not scared about what happens. I also want to say that there are certain things that are more sensitive to economic cycle. For some reason, the IWM, the small caps, are a lot more sensitive to economic cycles than, per se, like the SPY. You can see the SPY also suffers from the economic cycle here too, but it's just a lot less sensitive to it. There's a reason as to why that is. The majority of people, when they have their retirement fund, they buy S&P 500 stocks. They get exposed to S&P 500. So what ends up happening is a constant inflow of money that's going to these funds. Even during times of recessionary times, there's still going to be a pretty constant inflow. So you're just going to end up having a lot more stability with the S&P 500. Whereas for small cap stocks, not everybody ends up investing in them. Because you actually have to, a lot of times you actually end up like, some people want some small cap exposure and they get themselves involved in it. But what ends up happening, the majority of people, they just don't care. They shut their brain off. They don't really know much about the economy. They just keep letting their fund managers or keep letting their retirement funds to just keep adding to these larger cap stocks, and they just keep going up, like crazy. There's also another reason why I think S&P 500 has been less cyclical is because they keep rebalancing. Like if you don't make it to the top 500, they kick you out of it. So there's actually there's still some not so great company in the S&P 500. They still exist and they should eventually be kicked out at some point in the future. But the majority of them made it there because they've done something great, and that they also are sustaining a business that is need-based, and they're still around because their company is big enough and they're relevant enough that they're still around until they're not and then get kicked out. Whereas the small caps is a lot more unpredictable because small cap companies can come at any time. A lot of them are not money-making companies. And there are also a lot of financials that are also in the in the IWM here as well. So that's why they're gonna be more cyclical in general, and that's just the way it goes. Now, if you really want to dial up the leverage on this cyclicality, you want to go to the most speculative assets where things can drop like more than 90% during a bear run, but it can go up like hundreds and hundreds and hundreds of percent during a bull run. Then you're talking about Bitcoin, and because the whole economy runs in cycle. And because Bitcoin has been a scarce resource that has just been a very, very safe network is very decentralized, and money is starting to get pulled into it. There's a trust in the network. There is a lot of need for these money that's being printed from the deflationary forces to go somewhere. The best place to create wealth is to create these assets that have big market caps that actually people just end up hodling. I don't know how else to say this, but this is probably the best way to play economic cycle if that's something that you're into, is to look at more speculative assets that are more cyclical, that have been around for long enough that we know is not probably not going to zero, and that we've seen time and time again when there's an economic cycle that comes in, they go higher during the bull phase and they go much lower during the bear phase, but the overall trend is up. Now, with that said, is Bitcoin going to keep going up forever? I don't know. There are some people who think that Bitcoin, this is just a little bit of like a consolidation here before the next move up. I don't know if whether or not Bitcoinization, what some people are trying to say, is necessarily going to happen. There are some concern that Bitcoin does have this kind of rolling over look kind of thing to it. It does seem to have diminishing return as it goes on over the last, decade and a half. But overall, the theme is still that Bitcoin is still sucking in a lot of liquidity. And I don't see that changing anytime soon, especially now that there are financial instruments to allow the liquidity to go into Bitcoin that it didn't before. And we didn't really have all these ETFs, so like, the fund managers and Wall Street, they really didn't have any, way to get exposed to Bitcoin very much. But now with the ETF approval, we're actually starting to get a lot more ways for us to suck in liquidity into Bitcoin based on this cyclicality. So there's a potential that this cycle might actually go up higher than anyone would expect because of it. And on top of that, I also would argue that COVID actually prevented the cycle from happening. I still think there's a potential for Bitcoin to have hit maybe six figures if COVID didn't happen. COVID actually did slow down, or it did decelerate this uptrend here. I do think that uptrend would have started right around here, but COVID ended up delaying that by a lot. We have so far in this cycle and the cycle before that, we didn't really have this kind of artificial slowdown from a black swan event. So there is a potential that this could end up keep going, and it can keep going for another 12 to 18 months. And it can get pretty parabolic. And I don't know. I mean, or it may not. I don't think anybody's really able to tell you that. There's always going to be a lot of correction that can be pretty brutal, that could come down. Right now, Bitcoin is way above the upper Bollinger Band. I generally don't like that. Generally, most likely that's going to happen, and it might end up going sideways or down a little bit before its bullish continuation. But, nobody knows for sure. This could be, like another candle over here, which has gone way outside upper Bollinger Band. It's not even really touching it. But it just kept on having some bullish continuation, so you just never know what Bitcoin's going to do. Right? Same thing over here. There's a candle over here that didn't really touch upper Bollinger Band. It just ended up having some bullish continuation, although it did wick down and had a pretty bad correction. But you never know. Regardless, those are my thoughts. I think I spent a little bit too much time this time to talk about this. But those are my thoughts on economic cycles, on stocks, on S&P 500, on the Russell 2000, the cyclicality of IWM, as well as Bitcoin. Thank you for listening. Have a good one. Bye.